Durton says, "Hi, Joseph. What do you think about the reasons why VICI was formed? To be more precise, I'll quote somewhere below. VICI Properties," this is quote, "VICI Properties was formed as part of the Chapter 11 bankruptcy reorganization of Caesars Entertainment Operating Company, CEOC, the largest division of Caesars Entertainment. After placing CEOC into bankruptcy in 2015, Caesars proposed splitting CEOC into two companies, a REIT, which would own the company's casinos, that's VICI, and the operating company, which would manage them. That's Caesars Palace now." Yeah, that's correct. So in 2015, Caesars filed for bankruptcy. They were like Wynn, where they had both the landlord and the casino operator combined. They weren't separate companies like VICI and MGM and VICI and Caesars, and so on and so forth. I think it's becoming more common for them to separate the landlord aspect of it from the casino operator. Now, a few things, a bit of context, because first of all, this is like worrisome if you're reading about this and you're a VICI shareholder. Well, goodness, Caesars went bankrupt, right? What's to stop it from happening right away again? They went bankrupt because of the financial crisis, because traveling and that type of thing kind of dried up for a number of years. That's not good. That might happen with COVID. Well, there's one other key ingredient, a very key ingredient that led to Caesars bankruptcy in 2015. And that key ingredient leads to a lot of bankruptcies, not just Caesars. It's led to the bankruptcy of Toys R Us, with many other companies. It's not just Caesars, which is a leveraged buyout. Leverage, lots and lots and lots of leverage, lots of debt. That's what Caesars had. If you read about how much debt they had when they were originally formed, when they were purchased with a leverage buyout, which with a leverage buyout is basically when a company that's acquiring another company says, we don't really have enough money to acquire this company, so we're going to tack on an enormous amount of debt to buy this company. And with Caesars at the time, I believe that their debt ran as high as $24 billion. It was like 22 to 24 billion in debt, which is enormous. That's more debt, to put that in context. That is more debt than all of VICI's debt and Caesars Palace's debt currently. So VICI owns real estate way outside of all the Caesars holding, and they still have less debt than what Caesars had originally with that leverage buyout. So they were heavily levered. They were basically bought under the expectation that casinos would always do great and always be super profitable. And then they ran into the financial crisis, which of course was a big recession. The whole financial industry dried up. Many people lost their jobs. There wasn't as many conventions. There's all these issues that happened after they did this enormous leverage buyout, and that those ingredients mixed together led to a bad outcome where shareholders lost a lot of money. Of course, the debtors lost a lot of money because in the formation, they erased a lot of that debt. And the owners of VICI right now, many of them are those original debt owners. They got shares in these newly formed companies, so they're regaining some of those losses, I assume. But that is the history of Caesars Palace. One where there was a lot of debt and a financial recession all at the same time. But I think that what we need to monitor with VICI, if you're invested in this company, is history going to repeat themselves? Is VICI going to take on so much exorbitant amounts of debt that their debt to equity and debt to income ratios get so dramatically leveraged that it will lead to another outcome like this? And that's something that I intend to watch. If I think that their debt is getting above levels, it's outpacing their income, and it's making them more dangerous and more levered of a company, then that's a consideration. That'd make it so I wouldn't hold them long term. But I don't think that right now I could do comparables on it. I don't think that they're anywhere close. Both Caesars as an operator and VICI, I look at their debt and their total assets, and I think the numbers are way different. Their multiples different. VICI doesn't have as much debt as Caesars did back in 2015, and Caesars doesn't have as much debt. And both those companies combined together, even though VICI owns a lot of other stuff, they still don't have as much debt. So in my opinion, I think that this is a concern, the bankruptcy of Caesars, but you have to give it context. Leverage buyouts, I think, are very risky. They tack on so much debt. I remember the same thing happened with Toys R Us. People think that Toys R Us died because of Amazon and Walmart. That was one of the ingredients, but they could have survived if they weren't servicing exorbitant amounts of debt. Toys R Us had a leverage buyout, I think, from Bain Capital and different firms, and that put them in a terrible situation where they now had enormous monthly debt payments. And so they just could not keep the margins and pay the debt at the same time. If they had normal amounts of debt, Toys R Us would probably still be a company today. So it wasn't their business model. They were still doing okay. It was the fact that Walmart and Amazon were in much better financial positions, and they saw blood in the water. They saw that Toys R Us had a lot of debt, that they were close to going bankrupt because they couldn't service it. And Walmart and Amazon said, let's lower prices on all our toys for Christmas. Let's starve them of anything right now to get rid of them. And literally they did that. Walmart and Amazon both lowered their prices like crazy. They had way bigger toy selections, and part of their motivation was to kill off Toys R Us, knowing that they're in a compromised position. So, debt, again, leverage leads to bad outcomes in certain situations if it's wielded in too aggressive of ways, and that's what they did with the leverage buyout. Leverage can be used in good ways. REITs use lots of leverage. They wouldn't be able to grow and have the returns that they have, having 15 to 20% annualized returns. They didn't use any leverage. So I think that they'll use leverage smart, but we'll see. I'll be watching that as all these deals close, how leveraged VICI is, and if those multiples start going higher.